Is a 10 times your salary rule for finding life insurance still good advice? The 10 times your salary rule is a rule that was devised a while back for finding the right life insurance for a client. What it basically means is take the amount of salary that you make, multiply it by 10, and that number together will be how much life insurance death benefit you actually need for your family. In my opinion, this rule is a great starting point, but there's quite a few things that are missing that still need to be addressed when you're buying life insurance. First of all, it doesn't address the fact that most people, when they get the life insurance money, they try to pay out their mortgage. So they try to get the house completely paid so that they don't have to worry about those payments anymore. So if you're just doing 10 times your salary, you make $100,000 and now your death benefit is about $1 million. You end up dying, your spouse gets the $1 million. If your mortgage is $300,000 and your spouse uses it to pay it completely off, that's $300,000 less from the death benefit that now they have. What does that mean? Well, if the spouse is going to rely on that money in order to raise your child, then now they have $300 less of that money. That money is going to go a lot faster than they anticipated. So if you needed that money to last 10 years, now it's not going to last that long. It may last 7 years or even less, depending on how big that mortgage was. And there's other costs that go into this as well. For example, childcare. Childcare per child can cost about $20,000 to $40,000 per year. So if that's the case, then that number is still going to be reduced even more. If you want to provide an education fund for your child, that might be $100,000. Now that number decreases even more. And then if you had student loans that get transferred to your spouse upon death, those are still outstanding as well. So there's a huge gap between what you thought you were going to get and what you actually ended up with at the end of the day. And if that money was supposed to last your child at least 10 years, well, it's definitely not going to do that after it pays out for all those things. And that's why I say the 10-year rule is a good starting point, but not the end-all product. After you find out what your salary is times 10, now you got to add to that number what your mortgage is, what your outstanding student loans or joint debt with the spouses. You have to figure out how much you want to pay for childcare. Maybe you want to pay until your child gets into elementary school if they're an infant. And after that, you also want to think about an education fund for your child. How much were you wanting to pay for their school? And if so, add all those numbers into your death benefit, and that will be the actual amount that your family would need in order to be fully protected in the event that something may happen to you. So the 10X rule, completely outdated for today's families, but it's a great starting point. Don't use it to fully find your number, but use it as the base. You should have a minimum of that amount, and then make sure to add all the other things we talked about in order to get the correct protection for your family. If you found this video helpful, please like and subscribe. We'll be doing more of these videos answering common life insurance questions.